Welcome to today's webinar. It is an incredible privilege to be able to share with you two extremely well-recognized experts in this area. And we're going to be discussing something that is very close to any business owner's heart, which is how do I successfully transition, and is an ESOP right for your business? My name is Chris Chaney. I'm going to very quickly just kind of give you a little background here. We have with us Melissa Bizyak. She is a partner and the leader of the business valuation unit at Grossman Yanak Ford. We also have Douglas Ellis. He is a shareholder at Denton's Cohen & Grigsby. Both have decades of experience in ESOPs and employee benefit plans, and are going to give us a tremendous deep dive into this topic. And it is a complex topic. So a little bit about Fort Pitt Capital Group. As I mentioned, I'm a senior financial advisor with Fort Pitt. We are a money management firm with offices in Pittsburgh, Harrisburg, and Naples, Florida. We provide comprehensive planning-based portfolio management for individuals, institutions, businesses, and endowments across the country. Our sole focus is to help clients make the most of their money. So one of the ways that we can enrich the lives of our clients, because we are focused on not only helping them with everything that might touch their financial situation, but we want to address topics and concerns that go beyond those financial issues, things that matter to our clients' lives. We're a resource. And as you can see, not just financial advisors, life advisors. So today's topic has a potentially profound impact on the lives, especially of our business owners, their families, their businesses themselves, and their employees. And we're talking about employee stock ownership plans. Now, this is a retirement plan. A lot of folks think employee stock option plan. Nope, this is an ownership plan. And they'll both of our experts will give you details about this. And just a little bit of background on myself. As I said, live in the South Hills, very active. I've been doing this since the mid-'80s, and it's a great honor to work with two highly respected, recognized experts as we explore this particular topic. First, we have Melissa Bizyak. As I mentioned, she's a partner at Grossman Yanak Ford. She heads the Business Valuation and Litigation Support Services unit. She's been practicing for over 25 years with 28 years of experience in the valuation side of the business, and has built a substantial portfolio of ESOP clients over the last 15 years. She's been engaged in both the transactions and the annual valuation updates, all of which are important. She brings a significant amount of experience beyond that business valuation for privately held concerns and their owners. We're just honored to have her here today, and she'll be giving us a deep dive, especially into the accounting aspects of an ESOP. She is a recognized expert in this area. We also have, we have Doug Ellis, and as I mentioned, Doug is a shareholder. He's been practicing as well for a couple of decades, as well an expert in employee benefits, compensation, incentive packages with multiple very high-level firms, and now a shareholder at Denton's Cohen & Grigsby. So tremendous expertise from both of these honored participants. I do want to show you how to interact. If you're working on a cell phone, you want to look at the bottom right-hand side of your screen. You'll see a little call out. That's where you can put in questions, and you can download or access questionnaires. If you look on your desktop, you'll see the same thing right about in the middle on the right-hand side. Just click on that little handout. You'll see that. If you want to type in a question, please feel free. Just type it into the question area. We'll see it. We're going to focus, because there is so much expertise. We're going to really focus on the content and save most of the questions for the end of the session. But please do, by any means, share any questions that you have. We'd love to take advantage of their experts while they're here. Okay. And let me just move beyond here, because you can see where the pullouts are. So this is where I turn it over to Doug. Doug, we're going to look to you for an oversight of ESOPs.
Great. Thanks a lot, Chris. Can you all hear me well? Good. Make sure, and I appear to be in control of the slides, for good or bad. So there are a number of slides. So some of these, especially in the overview section, we're really going to kind of breeze through, but we wanted to give you as much background and sort of overview information about ESOPs before we sort of dive into at least a few more specific topics that we think, are especially interesting or unique aspects or opportunities with respect to using ESOPs. And we think, items that would be particularly relevant to business owners and other folks who are considering putting in place an ESOP. So just kind of a quick, overview of some of the numbers. There's 6,500 plus ESOPs in the U.S. With over 14 million participants in those plans, and they run the gamut. We put just a few examples. Some of the larger ones to some extent. So with Publix, one of the larger supermarket chains. Black & Veatch is an large engineering firm in Kansas City. I'll give you 3 guesses on what Jasper Engines and Transmissions does, but they actually do more than that, to give them credit. But they do engines and transmission work and manufacturing. And again, a $1 billion plus company in Jasper, Indiana, that operates as an ESOP. But you don't have to be a $1 billion company. You don't even really have to be a $1 million company. ESOPs will for the right circumstances work in any number of settings and for different types of companies and business owners. We highlighted that 57% of ESOPs are in S corporations. So a majority of them are S corporations, not C corporations. And we'll get into probably some of the primary reasons for that when we talk about the tax benefits of some of these ESOPs. And just to kind of highlight, again, not specific ESOPs, but industries where there are ESOPs, you can see 21% in manufacturing, 21% in professional science and technology companies, and then 15% in construction and 12% in finance, insurance, and real estate. So a wide range, but then you go beyond that into several other industries where it may be more 10% or less, but still a number of ESOPs in other industries that are operating there. So part of what we wanted to do today, I think, is to maybe address some of what we consider common misconceptions, or when we talk to individuals who are interested in ESOPs, or sort of going through that process of some reasons why, well, I don't think we can do it because X, Y, Z, and most of those doesn't mean that some of these aren't accurate. An ESOP is an employee benefit plan, but it's not necessarily primarily or only an employee benefit plan. It has a lot of other aspects to it. So a lot of these, sort of what we would consider misconceptions may apply in some instances. So they may be an issue you need to deal with, but in many cases, you don't have to deal with these sorts of issues with ESOPs. There are ways to address them that are pretty straightforward. So just to kind of give the sales pitch for ESOPs, the ESOP benefits are primarily to selling shareholders and to the company, although we will address some benefits that apply certainly to the employees and your workforce at those companies. But for the selling shareholders, it provides liquidity in a sale of those, and diversification of your assets in the company. It does prevent or protect the privacy of the company. You're not directly negotiating or dealing with a competitor that may want to buy the company through the ESOP process. And one of the biggest benefits of that is that you're deferring capital gains tax, or you have the ability under certain circumstances to defer capital gains taxes and just provide special or unique tax benefits to the selling shareholders. For the company, likewise, there's many tax advantages, and there also studies have shown that employee retention at ESOP companies is higher than it is at non-ESOP companies, and also profitability, productivity. generally speaking, based on the data, is greater at ESOP companies. So those, again, it's kind of an overview, just to get a little more in depth on some of the benefits. It does provide a market to the selling shareholders for their shares, where they're not having to go out into and find a third-party, buyer and deal with that. It's not a sort of end around where you can just, set the terms of your transaction as opposed to what you want to sell the shares for, as Melissa will get into in some of the valuation issues. But it is an alternative to having to go out and deal with the broader market of buyers out there. So with that, it's an effective means to exit the company for a controlling shareholder and diversify out of just the company's assets, which can be important. And sort of tied into the fourth bullet point there, that can all still be structured where you as the selling shareholder can continue to manage or have a role with the company and guiding the company and managing it moving forward, and retaining in many cases control over the business, which is not always the case, and very often it is simply not the case with a third-party buyer coming in. And as we said, significant potential tax benefits to selling shareholders in these ESOP transactions, which again we'll touch on later. So for the company to get into some of the more specific benefits, as we said, with the shareholders selling and continuing to manage the company, you can still have succession and set up that sort of business succession, where you're still controlling it and managing and using the same management team going forward. Assuming that that's working for you, an ESOP doesn't mean you have to change that. And again, it's for recruitment and retention purposes. ESOPs, generally speaking, have a much better track record overall on that front than non-ESOP companies, based on the research that's been done. And likewise, employee morale and productivity is generally higher with ESOP companies. Again, it can lead to or offer a reduction of corporate taxes for the company and an increase in cash flow. Sometimes you can really maximize that with an S corporation, as we'll get into. But even without the S corporation tax treatment, you can still have significant tax benefits to the company through, as we said, using pre-tax dollars for the financing of the debt, and potentially using that increased cash flow to grow the company through acquisitions or other growth strategies for the company. And for the employees, it's a significant benefit, as it is a qualified retirement plan. It gives them ownership interests in the company by participating in the ESOP without having to come out of pocket to purchase stock. And it also avoids their incurring taxes while that stock is increasing in value within the plan and in their accounts and over the period of time that they're with the company. So it really, again, along the morale and productivity and all of those aspects, it's intended in part to create an employee ownership culture within the company, so that the focus isn't necessarily on, well, this is my job, this is what I need to do when I come in every day, but it's thinking about the company overall and what that means and my role in that. And that takes a lot of communication and education for the participants in the plan, but it can really be a great benefit. And I know a lot of clients who put a lot of effort into that side of things to try to develop that with their employees and see real, tangible benefits from that. So for the process, I'm going to just kind of go through these very quickly, as I think for the most part we'll cover this in a little more detail as we go through the rest of the presentation. But just to kind of give a general sense of the process, if you're looking at implementing an ESOP and how that process would play out. It's not required, but typically we would recommend doing a feasibility study so that you can determine what makes the most sense for the company and for the selling shareholders, and sort of maximizing the potential tax benefits and the structure and design of the plan and the operation. Because again, you have this transaction, but then after the initial kind of ESOP transaction is over, you've got a qualified retirement plan. You've got potentially selling shareholders who are still participating in the company or still have other interests through seller financing or seller notes, or even phantom equity compensation, that sort of thing. So there's a lot of different interests that continue. It's not just looking at the individual transaction itself to see what makes the most sense or would work best for the company and the shareholders. So assuming that you go through the study and you determine this all makes sense, we should go down this road. Then you want to identify trustees. There's an ESOP trust that goes with the ESOP itself. And so you need a trustee for the plan to hold the stock and the other assets. And then you need accountants and investment advisors and valuation experts and lawyers and all of those other sort of advisors and individuals and administrators, again, with respect to once that plan is in place and going forward. So identifying who you need to engage for that purpose. And again, a lot of those individuals are involved in the ESOP transaction itself, but then they may continue to be involved after the plan is in place. Then financing. So typically, you're not going to have the cash just sitting around to purchase the shares for the ESOP. And so you need to get financing, either through a bank, through seller financing, or through other means that may make sense. And part of that, you need to do an appraisal of the value of the company and do an initial determination, because again, it's not a situation where you can just set a value on the shares and say that's what it is and that's what the ESOP's going to pay. So probably, if anything, the most significant number of regulatory issues that come up with the Department of Labor looking at ESOP transactions in particular has to do with the appraisal and the valuation of the stock and making sure that is appropriate under the standards that apply. And there's some very very difficult circumstances where that process hasn't been followed, where it can be very costly in that circumstance. So thinking through those issues and working through that with competent advisors is critical. Then for plan design, again, it's a retirement plan, so we have to go through how the plan will be structured and what sort of provisions, eligibility, vesting, that sort of thing will apply. And we'll get into some of that in later in the presentation. And then the legal documents, again, all of these things, everything we've just talked about, all gets documented. And so you've got plan documents, trust documents, valuation reports, and other documentation, accounting reports, and opinion letters, and then loan documents and all of that that needs to be prepared. And then you have the closing of the transaction where the trust acquires the shares for the ESOP. And then following that, you would get an IRS determination letter on the plan. And then you're into essentially the ongoing kind of day-to-day management of the plan and administration, which again involves testing and valuation and other other aspects that need to be maintained. So I just wanted to quickly touch on the leverage transaction, the concept of a leverage transaction. Not all of these arrangements are done or the ESOPs created by leverage transactions, but certainly a majority of them are. And so just to give you a background of how this process would work. So again, we said there's a trustee. Technically, the trustee can be a business member or manager or other insider. But for the transaction, you typically would have an independent trustee or an independent advisor to handle those aspects of the transaction. And so once you have the ESOP, the plan, and the trust in place, then you would use financing, typically through a bank or financial institution, and you also can have selling shareholders provide financing for the transaction. And essentially, you get an external loan using the bank or the seller financing to the company, and that provides cash to the company. And then the company uses those funds to make a loan to the ESOP trustee, which would be termed the internal loan. And then the ESOP trustee uses those proceeds of the loan to purchase the stock. And so it looks like a bit of we're just, shell game. We're moving the money around. But it is part of, and kind of unique, certainly, to any sort of qualified retirement plan, to be able to do this through a financed structure like this. And again, it is the typical way that this is handled. Those loans don't have to have the same maturity dates, and typically they don't. But they are generally handled by having the external loan and then those funds loaned to the ESOP trustee through the internal loan. And then as that goes through the company, once that's in place and the ESOP is holding the shares, the company, as it makes annual contributions or there's dividends paid on the shares held by the trust, those funds are used to pay down the internal loan to pay back the company. And as that loan is paid down, the shares in the trust are allocated to the participants. So on day one, the participants don't really have any direct interest in any of the shares, typically. That comes over time as that internal loan gets paid down and the shares are allocated. And then when distributions are made or participants are eligible for a distribution of their benefits, the company or the ESOP can repurchase those shares. In some cases, you're not even required to actually distribute the shares. But even if the shares are distributed, the company, especially in a private company situation, will typically repurchase those shares from the employees. So then the employees have cash essentially for the value of the shares. And then I should say the company is then paying off that external loan, either using the money that's coming back from the payment of the internal loan or other, other company funds to pay off that loan. So this is kind of a diagram of the leverage transaction, which basically just described that with the funds going from the bank or other financial institution to the company, which is the plan sponsor, through a loan. Then the company loans those funds to the ESOP, to the trustee, and then the ESOP uses those funds to purchase the shares. So I think that is kind of the overview for everyone on the ESOPs, and I'm going to go ahead and turn it over to Melissa now to talk about the valuation and tax considerations.
I actually, before I start into valuation considerations and some tax thoughts, I just wanted to really emphasize what Doug did a great job in talking about, and you know, that's the benefits of an ESOP. And currently, you know, my ESOP clients are really seeing those benefits in terms of retaining and attracting employees in this environment. It's a benefit that's always existed, but it's a benefit that is truly being realized now by my ESOP clients. So in addition to some of the other things that we'll talk about, you know, I think that having that ESOP culture is something that is extremely important and unique to this type of mechanism that's in place. So I'm going to talk a little bit about ESOP valuation considerations. We'll talk a little bit, keep it on a high level, tax considerations. But one of the things I'd like to mention is, you know, I do ESOP transactions, and I also work on non-ESOP transactions. And ESOP transactions, they require a little bit more due diligence to ensure that the transaction is fair to all ESOP participants. And ESOP trustees are really the fiduciaries that are charged with ensuring that ESOP participants are treated fairly. So one thing that an ESOP trustee, those fiduciaries, what they're looking for when they hire someone like me are a number of things. You want to make sure that the valuation professional, the financial expert, is qualified. Do we do this type of work? Not only valuation work, do we do valuations for ESOP transactions and, you know, ESOP ongoing clients? And that's really important because ESOP, the practice of valuation for ESOP is a little bit more nuanced than other types of valuations that I perform. So ensuring that the team that the trustee is relying upon to develop that valuation or appraisal, you know, have the qualifications necessary to get the work completed. Another thing that's really important is I want to make sure that your valuation professional and your certainly your trustee is independent. All these parties need to be independent of all parties to the transaction. So that's something that's very important and shouldn't be understated. So I can't have a situation where I have a potential ESOP transaction for which I've done some work for the sponsor company prior to the transaction. That's just not a situation where, you know, since we have selling shareholders on one side and I am typically on the side of the trustee, the buyer side, where, you know, we don't want to have any tarnish, any blemishes on a record in terms of independence. And then lastly, we want to make sure that the valuation professional ensures that they're meeting the requirements of both the Internal Revenue Service as well as Erisa, the Employee Retirement Income Security Act, that puts forth the protocols and certainly the parameters that are required to do the work for an ESOP transaction. So one of the things that, you know, we are charged with in terms of you know, value or price in an ESOP transaction is that the ESOP must receive no less than adequate consideration in exchange for the shares of the company. And the shares, as Doug had mentioned, could be, you know, a portion of the company or 100% of the shares of the company. It depends on the type of planning that's in place. But what must happen is it has to transact using this term, adequate consideration. So Erisa defines adequate consideration, as well as there was a proposed regulation by the DOL, and I believe it was back at, I think I was still in high school actually, in 1988. Although that's a proposed transaction, it was never made into law. Valuators and trustees look at the guidance in terms of how adequate consideration is defined. Sorry, it was a tongue twister. But really what the DOL said is, adequate consideration is akin to fair market value. And that's going to be the price at which this particular asset, and that would be the company stock, would exchange hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell. And then both parties have reasonable knowledge and are well informed about the asset that's about to transact. So understanding that adequate consideration is equated to fair market value. Fair market value is a financial value. What fair market value is not, it's not a strategic or an investment value. When you think about a strategic or an investment value, that's truly the value in a transaction with another company wherein you're going to achieve certain synergies, economies of scale. You're going to be combining balance sheets, all of that good stuff that's going to result in enhanced cash flow just by virtue of having those synergies in place. That's not what we're looking for here in terms of adequate consideration and fair market value. So, something that's very important that needs to be understood, especially at the outset when we're talking to our potential clients on, needing adequate consideration. So some of the valuation fundamentals, and this is one area, Doug, you alluded to this. The IRS and the DOL really look at challenges to valuations in ESOP transactions, and really most of those challenges, which started with a case called Great Bank, which involved a company named by the name of Sierra Aluminum. The heart of that issue was the forecasts that were prepared by management. The forecasts were a bit flawed in terms of assumptions that created enhanced cash flow that when the valuator went ahead and performed procedures under an income approach situation, it resulted in a value that was much inflated. So what happens is in any transaction and recurring annual ESOP valuation, the valuator is going to be really reviewing those management forecasts and kicking the tires with respect to assumptions and making sure that those assumptions make sense, and are reasonable. Does anyone have a perfect outlook for the future? No. We don't have a crystal ball. However, we're taking these reasonable means to understand those forecasts and to analyze those forecasts that are going to be based on factors that are internal to the company, as well as those factors that are external. Another thing is, valuators are going to be looking at three broad approaches to valuation. An income approach, which is basically what I was reviewing here, that involves employing financial forecasts of future cash flow of the business. The second approach would be a market approach, and that's actually going out and looking for multiples of either publicly traded companies or multiples that are results of transactions of privately held companies. But basically going out, much like you do for looking at real estate, looking at the value of your house, you want to look at comps. That's an approach that we use in valuing a business. And then a last approach is something that we call a cost asset approach, or looking at the balance sheet of a business. Unless that business is an asset holding company, typically we're not employing that particular approach. Why? Because a big component of value is going to be intangible value, and typically that's not going to be recorded on a balance sheet that's recorded under generally accepted accounting principles. And then lastly, we're going to perform an analysis of the transaction to determine whether the sponsor company has the ability to service the debt associated with the transaction. And that debt can be third-party debt at a bank, or the debt can be seller financing or a combination of both, and we see a lot of that. And one of the other things that, after the valuation is performed, a trustee will ask their financial expert to issue a fairness opinion relative to a few things. And this fairness opinion is really only focused on the financial aspect of the transaction, not the legal aspect. So what we are asked to do is determine whether or not the transaction price is not greater than fair market value, that there's no more than adequate consideration being paid, because why? That can harm the future ESOP participants. We will look to reasonableness of the interest rates that are being charged by a third-party bank, an outside an institution, as well as any rates that are associated with seller financing. We also look to the terms of the transaction as to if they are reasonable and fair to the ESOP only from a financial point of view. Just from a high level, to go through some tax benefits to a shareholder, you can sell any percentage of the company to the ESOP, but it must be for adequate consideration. You can defer the capital gain so long as the ESOP, the initial transaction is 30% or more of the company. And at that time, you have to be a C corporation. And after that, the proceeds of the sale have to be invested in qualified replacement property, which is under a code section 1042, the Internal Revenue Code. And then the shareholder will receive greater investment income, certainly since no tax will be paid and more of that income will be invested. Oops, can we go back 2 slides? I'm not sure how to do that. I apologize. Excellent. There are tax benefits certainly to the company because actually the company can take corporate tax deductions for at both federal and state level for interest and principal payments on loans of funds that are borrowed to fund the purchase of the ESOP shares. Annual contributions to the ESOP are tax deductible. There is a limit. It's up to 25% of covered payroll, which includes also employer contributions to other defined contribution plans. Dividends that are paid in cash or shares held by an ESOP can be tax deductible by the sponsor corporation. The dividends must be deemed to be reasonable, and these dividends are not subject to the 25% payroll deduction. ESOPs can qualify as shareholders in an S corporation. That's why, I mean, over 50%, the majority of ESOPs are S corporations. And why is that? Because to the extent that the S corp, whatever percentage ownership they have in the ESOP, it's not subject to tax at the federal level. So that's why we see many of our ESOP transactions initially to get the tax benefits starting out as a C corp, and then there is an eventual conversion to an S corporation to certainly realize those tax benefits. And then certainly special tax incentives for S corporation ESOPs. S corporations are pass-through entities, so when you're passing through any income to an ESOP, there's no tax. That is federal income tax that is being paid. So thus, an S corporation that is 100% owned by an ESOP, there's no federal income tax. Assets in the ESOP will then increase free of income taxes until there is a withdrawal. To give you a pretty simple high-level comparison, basically shows you a C corporation versus an S corporation. Same pass-through or same pre-tax income of $1.2 million. We're able to take a deduction for ESOP contribution in both situations of $200,000, which gives us pre-tax, adjusted pre-tax income of about $1 million. Looking at federal taxes at this point at 21%, a C corporation's net income at that point would be $790,000. When you look at an S corporation, the entire $1 million is therefore retained by the company. You know, when that happens on an ongoing basis, what you see is S corporation ESOPs that are able to fund a ton of growth. They have additional cash flow from which, one, the first objective is going to be repaying that debt associated with ESOP. And then after that, you know, mature ESOPs that are S corporations, you know, typically have cash flow available to expand and, you know, grow the company. So with that, I'm going to turn things over to Doug to talk about some legal considerations.
Great, thanks, Melissa. Let's see if I got my, there we go. So just to briefly touch on some of the legal considerations, in particular looking at it with respect to the ESOP being a qualified retirement plan. So as I said, you know, you've got the transaction, you have to sort of deal with the issues and the hoops that need to be jumped through to run the transaction appropriately. But then once you've done that, you then have a retirement plan that you need to deal with from an administrative and a compliance standpoint and a fiduciary standpoint. So again, and I think I had mentioned, I don't have it in here, but that the trustee, typically want to have an independent trustee at the time of the transaction to deal with all of those issues that Melissa pointed out about valuation and how the transaction is structured, and make sure it's fair and all of that. Once that's done and the ESOP has purchased the shares, typically you can go back to, and most companies do, go back to some form of either an insider as a trustee or you know, not having that necessarily independent trustee in place at that point. So there's some flexibility there. It doesn't mean you have to. You can certainly still keep an independent trustee, and there's benefits to that from a fiduciary standpoint under Erisa, but that you're not required to, and so that's often the case just from an administrative standpoint going forward. So just to quickly mention some of the fiduciary and administrative obligations. So once you've got the plan in place, you still have, you know, annual valuations that you need to do with respect to the shares. You know, and those are outside independent valuations again. There's annual record keeping and administration. And again, the ESOPs are a little different than your typical 401k plan. So you can't necessarily just go get the 401k administrator or record keeper to help with the ESOPs. But you do need those services, and there's Form 5500 filings, annual reports, there's audits that are typically required with respect to the plans. And you also have certain unique sort of participant rights that apply with respect to ESOPs that don't, because of that they're primarily invested in employer stock. So you've got diversification rights and put rights that I had mentioned earlier, the company or the ESOP buying back shares once those shares are distributed to participants. So, you know, you need to be aware of those rights and managing and administering those. There's repurchase obligations, which is another sort of subset of that, I suppose, in that being able to essentially fund, because you have to have the cash to manage those diversification and put rights and distribution rights that participants have. Typically, that isn't going to happen at the very beginning, because there's going to be a time where the participants need to, you know, earn their benefits in the plan and before they take distributions. But that is something that needs to be planned for, because it can be a big surprise to suddenly realize you have to come up with a bunch of cash to fund these repurchase obligations. And just again, I mentioned before, communications, education for the participants, so they understand the real benefits that they're getting from this. and what the opportunities really are, so they understand that what they're participating in. And then, evaluating offers to buy the company. Again, it's just another layer, I suppose, where we're dealing with fiduciary issues because the normal selling shareholder, business owner is not directly owning those shares anymore. So that is one area where you get into other fiduciary considerations that need to be considered when that happens with an ESOP company. And just generally, legal compliance beyond maintaining plan documents, summary plan descriptions, and things like that, and annual testing and other steps that need to be taken. Let's see if I can get that to. There we go. So with respect to some just additional legal considerations, the plans can be designed. There is a fair amount of flexibility similar to what you might have, say, in a 401k plan on eligibility requirements, how those are structured, and vesting requirements or schedules that may apply to participants' benefits in the ESOP. You still have all of those sorts of options and considerations when you're setting it up. One of the areas that I've had a lot of clients raise with us is what happens when a participant leaves, so they quit, they're no longer employed by the company, but they've got vested benefits in the ESOP, and they don't take a distribution. And if the benefits are above a certain dollar amount, you can't actually force them out. They have to stay in the plan until the person reaches retirement age before you can sort of cash those benefits out. So there's this concept of potentially they have like a free ride where they're getting the appreciation in the stock while they're not with the company and they're not providing services to the company. So there are ways to deal with that in structuring the ESOP and putting in place arrangements where, in essence, you cash them out of the stock and you put the funds into other investment options, either within the ESOP, or you can transfer that to, if you have a 401k plan, you can also maintain a 401k plan with the ESOP also in place. You can do a transfer there to put those, take those benefits out, or at least prevent them from continuing to get appreciation in the stock. Some companies, some owners prefer to just leave that as is and not address that. But there are ways to deal with that sort of free ride situation. And again, we've said before, you can maintain the same management structure. Voting rights are still generally can be controlled by the company. There are some pass-through voting, but they're on very limited circumstances where the participants would have a right to vote the shares allocated to their accounts. But in general, management can still continue to control the company and manage the company with the ESOP in place. And as we said before, selling shareholders can continue to work for the company, receive a salary. They very often are granted some form of additional equity compensation or phantom equity in the company that's outside of the ESOP. And other managers, not just the selling shareholders that continue to work, but other managers can also participate in that other equity compensation that can provide some additional benefits to them. So I think with that, I'll turn it over to Chris.
Thank you. Thank you, Doug, Melissa. Thank you very much. We've waded into some pretty dense detail here, and you can see the expertise and the experience that they're both bringing to this very specialized area. Let's just take a quick step back. We've got a few minutes. I just want to cover the personal side of this. What does this mean for you? What do you need to consider when you look at the possibility of an ESOP? More importantly, especially if you're a business owner, this is part of your exit plan. We need to make sure that this is going to work for you. So a couple quick things I want to just highlight. This is standard planning. Everybody here at the firm does this. First thing you want to do, define your future cash flow need. This is a little bit more difficult for a business owner because you've probably been running a lot of your expenses through the business. You're going to have to rationalize which ones will I assume, which ones will I eliminate. If you've got income that's coming through the business, whether it's rental income, does it need to be adjusted? Does that need to be rationalized? Were you charging too little, too much? There are various reasons to do that. But as you're making that move to the next stage, we need to make sure we put pencil to paper and really understand exactly what your potential living expenses are going to be so you can fulfill that hopefully second chapter in your life. That's important. Once we've identified the expenses, we need to identify assets and income. Think of it as sources and uses. So, will you continue working with the company? Will you continue to exercise the control that Doug and Melissa talked about? Outside of the income that you might generate from the company, will you be participating or receiving Social Security benefits or deferring them until the last possible minute, currently 70? That does give you an enhanced benefit over time. Do you have pension benefits? Do you, as I mentioned before, have rental income? What are all the non-portfolio sources of income that you're going to need in order to be able to determine how much do I need to draw from my portfolio? So again, if you're a business owner, this is an opportunity to create a liquidity event that's going to provide you with some meaningful resources, either upfront or cash flow over time. Either way, ideally, we will work with you and your tax advisor to especially identify the net proceeds that you might receive from such a transaction. Melissa talked about some of the tax benefits there are across the board. It's really important to make sure we understand exactly what your net benefit is going to be if you participate or implement an ESOP or any other exit plan. Once we've got that net number, we can determine, okay, here's your portfolio. Ideally, it's going to distribute about 2 to 3% per year. We want to make sure enough is retained so that, frankly, it can grow and maintain its purchasing power over time. As anybody knows, dealing with inflation today, purchasing power can erode very quickly. So sort of in our experience, about a 2 to 3% withdrawal rate tends to be a very meaningful but sustainable withdrawal rate over time. So the key thing is to determine what you need and then determine what your assets are. With both of those things in place, it's really, I just want to take one step back from that, saying most business owners own the vast majority of their wealth in their business. One of the most important things you can do is to start to build wealth in another pocket. Now, one of the easiest places to do that is an employer-sponsored retirement plan. Doug had just mentioned, you can have a 401k, great place to put assets into some other company besides yourself. You can take surplus cash that you might have. Once we've got the cash reserve established, you've got to make sure that your momentary needs are going to be addressed. Then we look at non-qualified investments. How can we make sure all of your investments are working for you? And again, estimating whatever your net proceeds might be. Melissa had mentioned a 1042 exchange. If you meet the requirements, I mean, there is a tremendous benefit to having this option. It's complex. It needs to be done with great care. Somebody like Melissa and Doug are exactly the kind of people that you would need to work with to set up something like this. If you don't participate in a 1042 exchange, qualified replacement property, then you do want to make sure that we incorporate the cash flow from those distributions into your retirement plan. Again, that's just part of what we do. It's a normal part of our projections whenever we're sitting down to help people retire. Determining the tax impact is really important. So ideally, we know what your net proceeds, as I mentioned, are, and there may be strategies that you can use to further defer some taxes. You'll notice at the bottom of this particular slide, charitable giving. There are plans that you can make. Some of these you need to do beforehand. Some of them you can do as you go along the way. But there are lots of different options to help reduce your tax impact. What's important is that ultimately it serves your specific needs and goals, because if it doesn't, it's not going to work well. The last thing I want to touch on real quickly is one of the things we focus on is optimizing your assets. And optimizing assets depends not only on your needs and goals, but it really depends upon where those assets are located. So after-tax assets, for instance, with the proceeds that you might receive from a distribution, those assets should be probably the most conservatively positioned assets that you have. Why? They're already taxed. So they're your least expensive from a tax perspective when you need to get money. Money in your retirement account is by definition much more expensive when you need to draw it out. It's going to be subject to ordinary income tax, so likely you're going to limit your withdrawals to just what you need, or when we work with clients who don't need that money, to optimize a Roth conversion so they can build tax-exempt assets. But because you're only taking out a little bit at a time, you're going to find the vast majority of your assets stay invested for a longer period of time. That's why your retirement accounts typically should be more aggressively postured than your after-tax money. So you're going to see that it's going to be much more growth oriented. And that's important because, again, over time, inflation erodes the purchasing power of your money. What we do take a look at, does it make sense to do a Roth conversion? Does it make sense to do backdoor Roth contributions, which for the moment are still permissible? Once you get to a certain age, generally 70 and a half, you can start considering qualified charitable distributions if you don't need the money. Until then, we generally try to optimize, as I said, those Roth conversions. Roth assets, which you see at the bottom, are tax exempt. Those are tax-free assets. Hard to get money into it. Ideal investment account, last account you'll ever want to touch when you need money. For that reason, the Roth should be your most growth-oriented strategy. But if you do this in this way, you're optimizing the resources based on the unique character and purpose of each account. And the goal here is to make sure that you've got plenty of money left over and that you don't run out of it before your time. So that's one of the things we work together. We take a look at all the assessments and evaluations and estimates that Melissa and Doug do to say, how can we help you realize your goals? Now, we do have a lot of questions that have arisen in the process. You can see some of these very quick bullets, but I do want to touch on a couple of questions that arose as we were talking. So not sure who wants to answer this, but one question that arose is there a particular size that is an ideal candidate, whether you're looking at employees, revenue, the value of the company? What would you recommend as a general parameter for a suitable ESOP candidate?
I don't know, Melissa, do you want to take, or I'm happy to talk on that?
Yeah, I mean, generally, I think there are a number of resources out there that will set the minimum threshold. You know, they say you want to have at least 25 employees. I mean, you know, I have a couple ESOPs that have a little bit less. You want to have value in excess of $5 million in terms of, you know, value of the business as a whole. But, you know, those things can, you know, certainly bend a little bit, but, you know, typically that's the minimum threshold that's been, I think, bantered about over a number of years. Doug, what are your thoughts on that?
Yeah, I think that's fair. I've seen, as you said, you know, certainly have seen ESOPs with you know, companies lower value with very small numbers. What you do see a lot of maybe professional firms or some like that where they have much lower numbers of participants eligible, but they tend to have much higher, you know, compensation and payrolls that factors into the valuation and the benefits under the ESOP. So it really depends on the company and the business, but you know, you certainly can see. I think your benchmarks are kind of for most common purposes would apply, but anything certainly, you know, larger than that, you're talking well within the scope of an ESOP based on participation or you know, or value of the company.
Thank you. Can a multi-member LLC, would that be a candidate for an ESOP?
Typically not. The only way that there is some guidance by the IRS that an LLC that's elected to be taxed as a corporation can be an ESOP, but that's fairly unusual. There may be certain, you know, tax reasons or purposes where that would work, but typically you're going to see it in the form of a C corporation or an S corporation.
Okay. How is the amount owned by each employee participant determined each year?
So that typically is a factor. There's different ways that you can do the calculation for the contribution, but typically, well, at a minimum, it is if you've got the leverage transaction, the minimum is it's the amount that's necessary to pay the annual payment on the internal loan. Because as we said, that internal loan, the company makes the contribution or I'd say that contribution with, if there's dividends on the shares, add those together in the aggregate would pay that loan. But you need to at least have the amount coming into the trust to pay up that annual payment on the loan. But beyond that, it really is typically what you would look at a factor of your payroll. So I see some companies that do, maybe the highest would be 15% of the payroll, but typically it's more in a lower single-digit percentage. But you really have flexibility. It doesn't need to be the same amount every year. It can fluctuate. Again, it typically ends up being a similar number, but that can fluctuate as long as you're at least putting the minimum amount in. And I think Melissa had mentioned there is a cap of 25% of the covered compensation, which is limited. So say an executive that's making $500,000 a year, you're limited in the amount that's recognized for their contribution based on the IRS values there. But it does give you a lot of flexibility on that front.
Okay, and are typically in a standard ESOP transaction, are there advisors on both sides?
Melissa, do you want to take that one?
Yeah, typically there'll be advisors on the sell side, which would be the current shareholders. They'll have legal advisors. Obviously, they'll have their accountants, and they'll have financial advisors on their side to determine what's a fair value that they can expect, and then advise them on how the transaction will take place. And then on the buyer side, which is the ESOP side, you have a trustee. And Doug had talked about having a transactional trustee and then going to an internal trustee. I mean, that can happen, but anytime there's a transaction, you want to make sure you have an independent trustee involved to ensure that that fiduciary duty is really in accordance with what the DOL and Erisa are seeking. They'll have a financial expert. They'll have attorneys. They'll have typically the trustee will have an attorney as well to help ensure that the proper diligence is done on the transaction. But yes, a lot of advisors will be involved in the initial transaction, and as one can then translate that to there are costs at the outset or at the installation of an ESOP. And then thereafter, the recurring costs are simply the annual valuation, which is required by the DOL. And certainly that cost is substantially lower than the initial transaction. And then if the trustee stays on, there are costs associated with the ongoing fiduciary responsibilities of the trustee.
Thank you. Excellent. Well, we've come to the end of the hour. I do want to thank you for your time. Obviously, an employee stock ownership plan provides compelling benefits to the owners, the employees, the company's legacy, the family, the community. And it's something that you should definitely consider if it feels like this has been right for you. It does entail significant costs and requirements, but you can clearly see with experts like Melissa and Doug, we've got the ability to help you assess if this is the right option for you. It may well be. Fortunately, they've got a lot of experience in this, so I hope you reach out to them if you determine that this is something you'd like to explore a little further and if it's right for your business. I do want to give you a little heads up here. We are looking at a couple of seminars, a couple of webinars in the near future. How to ace all 4 stages of financial planning. I mentioned that we focused on retirement planning, especially when you're talking about a business owner who's transitioning from living on cash flow on the business that they've built to living on portfolio income, or if you prefer, businesses that they didn't build but they bought into. That's a portfolio. It's something we're going to focus on in great detail. You can see we've got it in 2 parts over on October the 6th and October the 12th. We're looking forward to helping you just make the most of your money. It's been my absolute pleasure to spend this time with you. If you have any questions, anything you'd like to discuss at all, I really would recommend that you reach out, give us a call. And here's some contact information. Please feel free to reach out to Doug, to Melissa, both, as I said, highly recognized specialists in this area, among the leaders in Pittsburgh. We're really privileged to have their time and to share their expertise with you. So thank you again. Really appreciate your time. Check the downloads. We've given you a good bit of the outline that you've seen here in this presentation. And then just want to let you know that, as always, we do need to make sure that we're sharing our disclosures here. We are a registered investment advisor. We'd love to serve you. Again, Melissa, thank you so much. Doug, thank you for your expertise. We look forward to helping all of you with your questions. Take care and have a great day.